Oh, good morning, good morning, good morning. It is Wednesday, January 19th, 2022, and I am Kenny Polcari, your host of the party, and here I am today live, once again from Palm Beach. You can see the ocean behind me. It's calm, it's beautiful, yet there are clouds above, and they are a little bit dark right now, but we could see those clear up as the day gets started. But let's see, what is it? What is it that you need to know? What happened yesterday? The markets had a really difficult day. Across the board, everything got slammed. But what is it that you need to know? So the theme continues to play out, right? The theme of nervousness and anxiety and the Fed and rates. And there is, by the way, real wage inflation everywhere in the economy, says Davey Solomon, CEO at Goldman Sachs. Crude oil has hit a 7-year high on strong demand and rising geopolitical concerns. AT&T and Verizon are temporarily halting the 5G signals near and around U.S. airports as safety concerns build. And guess who's back on the stage? Billy Ackman, right? This time, though, he didn't cry like he did in March of 2020. But the question is, what was he buying as he helped to talk the markets lower yesterday? We'll certainly find out about that. And what are we having for dinner tonight? We're going to have the stuffed chicken breast. Easy, sounds more complicated, not so difficult, just pay attention. So yesterday morning, if you remember, I ended my note with this. The S&P closed at 46.62 on Friday. Intermediate support is at 45.75, which is only 87 points from here, or just 1.8%, a level that we could easily pierce before the day is out. The trend line is key at this point. A failure there would open the floodgates to test lower. Expect the algos to kick in and for the buyers to retreat, again asking, why should I stand in the way and get run over? Right? And so that continues to be the theme. And yesterday at 12:54 p.m. on Tuesday, January 18th, the S&P breached 45.75, falling 6 more points to put in a low of 45.68 before recovering slightly and then moving lower once again into the bell. 10-year Treasury surged up to 1.87%, and by 4 p.m. the Dow was off by 545 points or 1.5%. The S&P's down 85 points, 1.9%. The Nasdaq off 385 points or 2.6%. The Russell down 66 points or 3%. The transports gave up 248 points or 1.5%. It was an ugly day for tech, and it was an even uglier day for small caps and mid caps. The Dow is now down 3.7% since a December high and 2.7% year to date. Not a disaster at all. The S&P is off 4.5% since a December high and 4% year to date. Again, not a disaster. The Nasdaq, though, is by far the biggest loser, down 10.5% in official correction territory since the November high, and it's down 7.3% year to date. Now, just to be clear, the Nasdaq has now pierced its 200-day moving trend line, something it hasn't done since March 6, 2020, when it fell a total of 32% before the Fed pushed out their COVID-19 stimulus plan. The Russell is off 14%, also in correction territory since the November highs, and it's off 6.5% year to date, while the transports are down 8.25% since the November high, and year to date they are down 5%. So not completely a disaster. Every sector in the S&P 11 sectors was lower yesterday except for energy. The XLE was up 0.4%. Tech, though, down 2.5%. Financials down 2.2%. Consumer discretionary off 1.9%. Consumer staples off 1.4%. Healthcare off 1.4%. Basic materials down 1.3%. Utilities off 1.2%. Communication stocks down 1.2%. And industrials off 1.1%. The value trade, the SPYV, fell by 1.5%, while the growth trade, the SPYG, fell by 2.4%. Home builders, the XHB, lost 2.8%. Think about rising interest rates and the cost to own a home. Retail sold off 2.5%. Disruptive tech, known as ARK, fell by another 4.2%. Just FYI, this ETF is now down 52% from the February highs. It's down 38% from the December high, and it's down 21% year to date. Well into bear market territory. All this weakness leaves one to ask, wait a minute. Where are all those buy the dippers? Oh boy, hello? Let me explain. The Fed has lost control of the narrative. They have lost control of inflation. They've lost control of their senses, allowing some talking heads to suggest even more dramatic moves by the Fed, causing all this nervousness and angst. Remember, on January 3rd, it was Goldman Sachs who called for 4 hikes. On Friday, it was Jamie Dimon who called for 6 or 7 rate hikes. And yesterday, it was once again Billy Ackman of Pershing Square. Now, you do remember the histrionics he created on CNBC in the winter of March of 2020 when he cried on TV saying that hell was coming. And he pleaded with Trump to shut down the country for 30 days. And that helped to send markets into a tailspin that day, if you remember. It was only days later when the Fed launched their massive stimulus program and stocks and markets began to recover. And then it was revealed that Billy was actually out there quietly buying stocks in some of the names, Hilton just one, that he was talking down during his crybaby moment. Yesterday in his Bloomberg interview and on a tweet, he came back with this. And he's not really wrong, but this is part of, his reappearance. While it has become conventional wisdom that the Federal Reserve will raise rates 3 or 4 times this year to mitigate inflation, the market expects 25 basis point increment moves. The unresolved elephant in the room is the loss of the Fed's perceived credibility as an inflation fighter, and whether 3 or 4 would therefore even be enough. The Fed could work to restore credibility with an initial 50 basis point move to shock and awe the market, which would demonstrate the resolve on inflation. Now, I'm not necessarily saying that he's wrong. I think that's right. I think we are going to get a 50 basis point move. I think we should. And while I agree that the Fed has lost control of the narrative and lost control of inflation, I am still in the camp that we are only going to see 3 rate hikes this year. But 3 rate hikes that will take us to a total of 1 full percentage point move, right? Which means that one of those 3 has to be a 50 basis point move, allowing the other 2 to just be 2 25 basis point moves versus 4 25 basis point moves, right? You see where I'm going? We still end up with a full percentage point move. We just get there in a more aggressive way. And that, my friends, is what has been causing the recent angst and the volatile behavior. Yesterday, it was Billy's turn to be on the stage. The question is, I wonder what he was buying while he was helping to talk markets down once again. And I'm sure somebody's going to do that research. Anyway, so next week is the FOMC meeting, right? The Federal Open Market Committee. Members of that FOMC are now in quarantine. No talking to the media. And that leaves the place ripe for speculation and commentary from a range of talking heads. Now, if the Fed jams a 50 basis point move down our throats to counter the effects of keeping rates at 0 for far too long, which has ignited this inflation monster, then investors could respond in one of 2 ways. The first could be this sell the rumor, buy the news type of event, which is kind of what we're seeing now because it's still only a rumor and stocks are getting crushed, where investors will continue to reprice stocks, think sell, ahead of the Fed announcement next week, and then switch gears and become a buyer of the same names that they destroyed once the Fed announces their stance in what would be seen as a relief rally, right? Because they made a decision and they actually did it. Or a 50 basis point move could suggest that they're panicking even more, believing that the Fed is drowning under the weight of their policies, essentially admitting that they got it all wrong. And if that happens, the current year-to-date losses that look mild in comparison to what we would see if that's the reaction we get. The talk of a correction in a bear market, which is already happening in the tech space, will become talk of a bear market across the board. But you must admit, the jawboning tactic that they're using is working beautifully, isn't it? The Fed has enlisted the help of all these respected voices, right? Goldman, JP Morgan, and others. Encourage them to help do the dirty work, take some of the air out of the balloon, send stocks lower all ahead of the FOMC meeting. Again, it's all very orchestrated and it's all very real. And if you think it isn't, wake up. Okay, so what's happening this morning? U.S. futures are up. The Dow, they were weaker into the early morning. They turned up around 6 o'clock. Dow up 35, the S&P's up 6, the Nasdaq up 60. The Russell's ahead by 3. Asian markets ended the day lower as the negative tone from yesterday kind of swept across the Pacific. European markets, so this morning, are bucking that trend. The German Bund made history this morning. Yields went from negative to positive. Now, nothing really dramatic, but they are now in positive territory, even if ever so slightly, and that's the first time that's happened since 2019. Eco data this morning includes mortgage apps and housing starts, right? Housing starts are expected to be down 1.7%. Building permits are expected to be down 0.8%. But again, don't expect this macro data to drive the action. It will not. It's going to be about earnings, and it's going to be about what the C-suite has to say. Look for earnings today from United Healthcare, Procter & Gamble, U.S. Bank, PLD, Bank of America, Fastenal, Morgan Stanley, and State Street. Yesterday, Goldman reported a miss on all lines, with Davey Solomon, the CEO, telling investors that he needed to boost pay by $4.4 billion, or 33%, to remain competitive, and that wage inflation is a real problem. This morning, we also find out that JP Morgan is raising pay for all their junior bankers across the board to help them fight the effects of rising prices, rising rents, and rising car payments, et cetera, et cetera, et cetera. And oil, once again, is up this morning, rising 1.3% at $86.50 a barrel. Treasury yields now pushing 1.88%, and cryptos continue to get sold. Bitcoin down 2%, Ethereum down almost 3%, and Chainlink down 7.4% in the last 10 hours. The S&P closed last night at 45.77. It is sitting right on the trend line, right? Yesterday we pierced it, but managed to hold on. This morning, futures did test lower, but have since turned up just a bit. The trend line remains key at this point, and I would not be surprised to see us test it at least 2 more times before we find out which way the next move is going to be. A failure to hold will open the floodgates to test lower, while a move up will attempt to settle the mood, right? A mood that is at best nervous. And that's going to cause me to ask once again, why should I stand in the way and get run over? Why would I be chasing anything? I'm not. Patience in this case is very much a virtue. Remember, you can text the word invest to 21,000 on your cell phone to get my digital business card. Feel free to download it. You can send me off an email or text. I'm always happy to engage and talk about markets, planning, thoughts, concerns, and ideas. Okay. So now what's for dinner, right? We're going to make these stuffed chicken breasts, and we're going to stuff these with kind of mushrooms and leeks that we've sauteed. I'm going to give you that recipe in a moment. It sounds more difficult than it is, but it really isn't. And it's actually kind of creative, because remember, you can stuff chicken breasts with a bunch of things, but today we're going to do it with mushrooms and leeks, right? And like I said, while it sounds or it looks more difficult and complicated, it really isn't. So for this, you're going to need 4 butterfly thin sliced boneless breasts. You need olive oil, you need white mushrooms sliced thin, you need 1 medium leek, the whites only. You need garlic, fresh thyme leaves, fresh lemon juice, dry white wine, Pinot Grigio, Santa Margherita, chicken broth, and some twine, right? Some cooking twine. For the sauce that you're going to need, you need Dijon mustard, and you need butter, and you need some more salt and pepper. Okay, so now you're going to go to the butcher. You're going to trim the breast just enough to make them. You're going to pound them. They're going to be thin sliced, pounded thin. You're going to trim them to make them into a rectangle, right? So you kind of want to square them off, make them in a rectangle. In a skillet, you want to heat up a splash of olive oil. You want to add the mushrooms, cook those, allowing the moisture to evaporate and the mushrooms to cook. Then you're going to add a bit more of oil, and now toss in the sliced and chopped leeks. Saute those with the mushrooms for about 5 or 8 more minutes. Now add the chopped garlic and a half a teaspoon of fresh thyme. Saute that around for a couple of minutes. Add in a teaspoon of lemon juice and cook until that juice evaporates. Now transfer this mixture to a food processor bowl. Pulse the mushroom mixture in the food processor until it's just finely chopped. You don't want to make mush out of it, right? Season it with salt and pepper, and then just leave it aside. Now take your cutlets, spread them out on wax paper. Take the mixture that you just processed in the food processor, and you want to lay it out over the cutlet, right? Leaving room all around the edges. Now you want to roll the cutlet as tightly as possible without squeezing too hard. Then you want to tie it up with the cooking twine. Now you want to season the rolled chicken with salt and pepper. You want to go back to that same skillet that you used for the mushrooms and the leeks, right? You want to add a splash of olive oil. You want to heat it up. You want to add the rolled chicken pieces and brown it on all sides, right? So turn them over till they're nice and brown. After that, add 1 cup of wine and 1 cup of chicken broth. Bring that to a boil, then reduce to a simmer. Cover and cook for 15 minutes or so, right? You can turn the chicken while it's simmering. After about 15-20 minutes, remove the chicken alone and just place it on a serving platter and tent it with foil just to keep it warm, because now you're going to finish off the sauce. In the same skillet with the wine and the chicken broth, you're going to whisk in 1 teaspoon of the mustard into the sauce. Remember, you want grain mustard like Gulden's, not the yellow French's. You want to turn the heat up high. You want to reduce it all till it's about a half a cup, 5 minutes or so. You want to remove it from the heat. You're going to then add 2 tablespoons of butter and some fresh lemon juice. Season it with salt and pepper. Stir it up. Taste it. Make sure it's right. Now you're going to cut the twine off the chicken. You're going to slice the chicken into medallion pieces. Each piece should produce about 6 medallion pieces, right? When you serve it on the platter, you could serve it on a big family style platter, you could serve it on individual plates. You want to spoon the sauce that you just made over the medallions. Serve this with something simple like a sauteed spinach that you have in garlic and oil. And you can always have a large salad if that's what you want. In any event, look at this. You can see the sun just coming up over the horizon there. You can see the rays of sunshine trying to dissipate the dark clouds that are above my head. So let's see if that's what happens in the markets today. In any event, until tomorrow, take good care.